Good morning and welcome to the Killik podcast for Friday the 19th of June. This week the market's been surprisingly resilient given the lack of resolution in Greece, and I think that's been because of the Fed June FOMC meeting. So three key points came out of the meeting. Firstly, that policymakers are more split on whether we have one or two rate rises this year, and that's a more dovish position. Secondly, that the Fed is now projecting a shallower increase in interest rates, so probably one less rate rise in 2016. Thirdly, growth and employment were pulled back a little, so the poor economy in Q1 has corrected sort of less strongly than perhaps the Fed were looking for, so they've become a little bit more cautious on the full year outcome. But they're also saying they expect inflation to start coming through a little bit more strongly because of a stable dollar and a stable to rising energy price. The other side of the sort of macroeconomic coin this week was the Greek situation. So nothing resolved last night, and we go into an emergency summit meeting on Monday with the Eurozone leaders in Brussels. So these two forces in the market are sort of quite neatly illustrated by the euro dollar, which actually strengthened this week. So the euro strengthened against the dollar, which is surprising given what's going on in Greece. And that is tells us a lot about where markets are positioned and the fact that they're sort of the bigger weight of news was the fact that we saw interest rates going up less quickly in the US than expected. So looking at the sort of contagion risk in the Eurozone, here we've got the peripheral yields. We look at this quite a lot because we're worrying about what happens to Greek yields, whether that starts to spread into the Eurozone peripheral states bond markets. So we've seen a bit of a rise in the 10-year yields on Portugal, Spain, Italy, and Ireland to a certain extent. But they remain well short of where we were in 2011-12 when we were in that Eurozone crisis where Greece was in a similar position to where they are. Equally, obviously, they have come off the lows, but those yields have been backed up by core yields in core Europe going up as well. So it's not just a sort of contagion risk play there. Equally, we're looking at the banks. They should be the most sensitive to problems with some sort of default in Europe, in Greece. And they're actually outperforming the Eurozone markets year to date. So that again says that the market is fairly relaxed still about the lack of resolution in this Greek situation. We've also been watching wage inflation, and we got a stronger number in the 3-month UK average weekly earnings, and as you can see, that chart's starting to go north fairly aggressively. This is symptomatic of us getting to a state where the unemployment rate in the UK is near a full employment. And if we go back to 2004, unemployment troughed at 4.8% and 5.2% in 2008. We're currently at 5.6% unemployment in the UK from a 5.8% high in the sort of nearer future. So with wages rising, that's obviously going to impact company margins. It's something that we worry about. And with lack of labour capacity, we need to see productivity starting to grow. And here we've got a chart of UK productivity, which has started to come off the bottom. But again, if you look back over a longer time period, it's been flatlining after a period of sort of fairly constant rises. So productivity has become a little bit of a conundrum, and we'll go back to that later in this presentation. So one of the other things that came out of the Fed statement this week was that inflation should start to rise. So we're seeing a little bit of wage inflation. We're seeing oil stabilize. We're seeing the trade-weighted US dollar start to stabilize. So what applies to the US also applies to the UK, and we can see the headline CPI and RPI rates starting to come off zero, which is where they've been for a number of months. And therefore we see an opportunity in index-linked bonds. And this chart just shows the 7 Trent index linker against the institutional index linker. And here you can see during periods where inflation expectations were high, so we're looking at sort of around 3% to 5% inflation expectations during this period, retail investors bought into index-linked bonds. At the moment, because CPI is zero, there's not that much interest in index-linked amongst the retail community, and therefore you're getting those bonds at a very attractive relative valuation to the institutional share class, bond class. So more information on that, you can see a note that we published recently from our fixed interest team. Another interesting play on, as I say, this productivity conundrum where we've been going sideways for a number of months is Accenture, and they report next week, so we'll be watching that quite closely. So Accenture are a global leading digital consultancy business, and their chief selling point is that they feel that the world is becoming increasingly interconnected with the internet, cloud, personalization, data analytics, and most companies need at some stage to improve their interaction with the internet, and they're the leader in this field. So we can see very decent growth rates coming out of this business as more and more businesses realize the need to become more productive through using the internet. And we see that Accenture improving their margins by moving to a revenue model where they share the benefits of the value that they add, whether it's in revenue gains or in cost savings. So we think that's a really interesting stock that we'll be watching closely this week. Also reporting this week, we've got Vodafone on Wednesday. We got Nike, which is a big one for us, on Thursday. Nike, we're still expecting sort of high teens, mid to high teens earnings growth coming through. We expect the dollar issues that have hampered the results in the last couple of quarters to have sort of stabilized and come out of the equation. Clearly spending will be picking up for the Rio Olympics, so we've got to watch that, but we still feel that stock and that business is very much on track. We've also got Tesco's on Friday, which will be interesting. Just looking at a new recommendation, we've got Goldman Sachs. This is a fairly simple story. Huge amount of capacities come out of the investment banking arena, and Goldman Sachs is one of the last men standing with JP Morgan. So they are the world leader in investment banking at a time when M&A transactions in the US are now rising and back to where we were back in 2007. So clearly, volumes going up, margins will be expanding because of the lack of competition in that space. As a business, they've been extremely successful in growing NAV throughout the cycle since 2001. And here you can see how they've grown their net asset value per share against their global peers, far outstretching the average in their sector, yet we haven't seen the same reaction to the share price. So at the moment, the business has also gone through a huge delevering process from 2007. So we're back to this 10% leverage ratio, which is far more comfortable. And we can buy this stock on around 10 times earnings. So the market seems to be viewing investment banks as ex-growth, but as the M&A numbers would suggest, that's far from the case. So we think that's very attractive here. So that's it from me. Have a good weekend. Thanks very much.